Up, down, then up again or in a roundabout way. The stock markets are now in as uncertain a period as they can be. The main catalyst for the movements is no longer companies, but Donald Trump, who is capable of driving the price of the indices up by as much as 10% a day, depending on how he sleeps. But it is important to be aware of the reality, which is not entirely pretty. The world is in the middle of a tariff war that can spin stocks at will. The US has indeed suspended tariffs on most countries, but tariffs on China are a whopping 145%. In times of tariff wars, this market behavior is quite common, but these rapid gains that we saw on Wednesday did not define the end of the declines. On the contrary, these biggest increases come during recessions and bear markets. After these, the price historically goes even lower. With these indicators and the data we're going to look at, we'll see what we can expect from the stock market going forward. The most significant and now globally visible aspect of the tariffs is their impact on the stock market. History has shown that tariffs can cause an immediate market correction and destroy investor returns. But they also backfire on US producers and consumers, which is often worse. While tariffs are mainly directed against foreign companies and governments, their consequences are often much greater. Proponents of protectionist measures on steel, lumber, electric cars, and other products need to understand that everyone who invests in the stock market has suffered losses because of these policies. It is not just the 60% or so of Americans who directly own stocks, often in their retirement accounts, that will be affected, including union pensions and teachers' pension plans. The minor boost to some sectors, such as insurance companies, which the White House has targeted, is more than wiped out by the trillions wiped out from market capitalization in the major indexes and the domestic economic disruption. You can find a summary of which ones are now below their intrinsic value in the Fair Price Index at 𝗕𝗂𝗶ecie. The big problem in this situation is that once US tariffs are imposed, some other countries, led by China, retaliate, causing further earnings and stock price declines. The Hang Seng Index fell a record 13% in a single day on Monday. The markets are reacting to the tariffs with huge volatility, because no one knows what will happen in a few hours and where the next blow will come from. These three examples from history show what markets look like when tariff wars are unleashed. In 1928, President Herbert Hoover led a tariff campaign to support American agriculture. But the original tariffs that were imposed after his election later expanded to include a tax on up to 25,000 imported products. The stock market crash began on October 28, 1929. The New York Times front-page article read, "Government insists more tariffs go into effect." Although the Tariff Act did not go into effect until June 1930, its effects had already been felt 8 months earlier. The markets reacted immediately, discounting future profits. The gold standard was still in place at the time, but it was not responsible for this decline. What is the takeaway from this, and did it apply 100 years ago? Markets do not price the current situation, but are a kind of projection of the future. Stock markets rise in price, depending on the outlook of investors. Hence the rapid nature of the decline, just as now. In the 1920s, this decline was compounded by the large amount of leveraged buying that investors used after years of growth to which they were accustomed. But that rapid decline led to margin calls, which further intensified the sell-off. Within 2 months, the S&P 500 index had collapsed by 36.5%. But what is growing strongly is the number of subscribers to our channel. So don't miss any of the top information and news, of which there is now plenty. By 1934, world trade had fallen by 66% to 1905 levels. The Great Depression continued, which increased economic nationalism and allowed radicals to rise to power, resulting in World War II. Much later, at the start of the new millennium, hawks, those who favor low inflation over economic growth, still believed that tariffs protected American jobs. Recent history shows otherwise. President George Bush imposed tariffs on steel on March 20, 2002. And what didn't happen? The manufacturing industry lost 475,000 jobs from March 2002 to March 2003, more than existed in the entire steel industry. Producers were unable to pass on higher steel prices to their customers. The tariff had an impact on the performance of the stock market. This fact is often overlooked, given the attention given to the collapse of the dot-com bubble in the previous 2 years. Between March 2002 and May 2003, when the tariffs were imposed, the S&P 500 index lost $2 trillion in market value. The indexes did not fully recover until the steel tariffs were lifted on December 4, 2003. The Bush administration lifted the tariffs after learning that the European Union would retaliate. If this were to happen, the U.S. stock market could suffer another sharp fall, as it did in 1929. And thirdly, the recent tariff war, which brings us back to Trump. During Trump's first administration, the stock market peaked in January 2018, when President Trump announced tariffs against China. China responded in the same way. It also imposed tariffs on steel and aluminum imports from around the world, including Mexico, Canada, and the European Union. Tariffs were also imposed on Canadian lumber, leading to higher domestic prices. The market plunged and peaked in August after falling by almost 12%. This dispute between the major powers has had the least impact on the markets of all those discussed. However, they still managed to sell off from a new peak of 20% at the end of 2018 to even lower levels than immediately after the tariffs were introduced. The tariff war was therefore by no means a matter of days or weeks. It is important to take this into account and approach the markets accordingly. But the most important thing is that, of all the problems and crises, whether minor or major, in the end, equities were the assets that managed to appreciate the most in the long term. That's why it's now more important than ever to pick quality companies that are below their fair price. More than 2,200 𝗕𝗂𝗶ecie Black members already know how to find them, with all the benefits of 𝗕𝗂𝗶ecie, such as the portfolio tracker or the unrivaled flash news, together with the Fair Price Index, where you can find thousands of stocks with a calculated fair price according to DCF and relative valuation. With the other data on 𝗕𝗂𝗶ecie, you can create an absolutely perfect analysis and benefit from the current sell-offs. So the CLAs are by no means good news for the economy, but it has always been a transitional period. Tariffs will pay off for American entrepreneurs, consumers, and businesses. Repeating the failed trade tactics of the past will only lead to a temporary underperformance of the stock markets and a massive disruption to the economy. But this is where investors build the greatest wealth, because stocks have always been able to recover from every crash and still make a profit. There's a new video coming out on Monday, so be sure to subscribe so you don't miss it. Share your perspectives with investors on 𝗕𝗂𝗶ecie, who are now tackling buying quality stocks that have fallen below their intrinsic value thanks to the sell-off. Or let's chat in the comments. Good luck with your investments.